In the financial world, the term valuation is crucial to determine whether a stock is overvalued, undervalued, or fairly priced. In recent years, valuations in the U.S. stock market have reached historically high levels. This dynamic chart is based on the graph displayed on screen, with sources listed at the bottom for added credibility. In this video, we'll explore how valuations have reached these extremes, the factors that have contributed to this, and what could happen next. Stay with us. To begin, we need to understand the tools analysts use to measure market valuations. There are several metrics, but the most popular ones include price-to-earnings ratio. This indicator measures how much investors are willing to pay for each dollar of earnings generated by a company. When the average P/E of a market is significantly above its historical average, it's a sign of potential overvaluation. Price-to-sales ratio. This method evaluates a stock's price in relation to the company's revenue. Throughout history, these indicators have shown a significant correlation with long-term market performance. When valuations are at extreme levels, future returns are generally lower. Extreme valuations are not a new phenomenon. The U.S. market has experienced multiple bubbles and collapses throughout its history. Let's consider three key episodes. The Great Depression. Before the collapse, the market displayed extraordinarily high valuations driven by unchecked optimism. The 1929 crash marked a drastic correction. The dot-com bubble. During this period, tech companies reached disproportionate valuations, many without generating real profits. The burst resulted in significant losses. The 2008 financial crisis. While this crisis wasn't driven by extremely high valuations, it did highlight the risks of excessive leverage. Today, valuation levels in many cases exceed those seen during these crises. This raises important questions about how long this environment can persist. There are several reasons why U.S. market valuations are at extreme levels. Let's analyze the main factors. Low interest rate policies. Since the 2008 financial crisis, central banks have maintained historically low interest rates. This has encouraged investors to seek returns in the stock market, driving up prices. Fiscal and monetary stimulus. The stimulus packages released during the COVID-19 pandemic injected a large amount of liquidity into the economy, boosting demand for financial assets. Concentration in tech giants. Companies like Apple, Microsoft, and Tesla have seen their valuations soar to astonishing levels, significantly influencing the S&P 500 index due to their substantial weight. Optimistic narratives. Investors are betting on trends like artificial intelligence, renewable energy, and blockchain technology, inflating prices in these areas. Why should we be concerned about an overvalued market? There are several reasons. Lower future returns. Historically, when valuations are extremely high, long-term returns tend to be lower. Higher risk of correction. Overvalued markets are more vulnerable to sharp corrections as prices adjust to economic reality. Impact on regular investors. High prices make it harder for investors to buy assets at reasonable prices, potentially delaying their financial goals. No one can predict the future with certainty, but there are several possible scenarios. Moderate correction. Prices could adjust gradually if corporate earnings grow enough to justify current valuations. Bubble burst. An unexpected event could trigger a massive sell-off in the markets, similar to what happened in 2000. Prolonged high valuations. With sufficient liquidity and confidence, valuations could remain at high levels for an extended period. Although extreme valuations may seem daunting, there are ways to manage these risks. Diversification. Don't put all your eggs in one basket. Consider investing in international markets, bonds, and other assets. Long-term strategies. Avoid making decisions based on short-term market fluctuations. Fundamental analysis. Prioritize investing in companies with strong fundamentals and real growth prospects. Maintain an emergency fund. It's always important to have liquidity to seize opportunities or face unforeseen events. Extreme valuations in the U.S. market are a reminder of the inherent risks of investing. While there's no easy answer as to when or how a correction might occur, staying informed and prepared is the best way to protect your portfolio. Remember, the market can remain irrational longer than one can stay solvent, but patience and discipline have always proven to be allies of smart investors. Thank you for joining us in this analysis. If you enjoyed this content, don't forget to subscribe and turn on notifications for more videos about market analysis and investment strategies. Also, we invite you to watch our video where we analyze whether there's a potential bubble in the U.S. healthcare sector. See you in the next video.